Good evening, guys, and we're gonna do Friday's Fit. I wanted to just go over a couple things before we start. Mike's gonna talk about the macroeconomic situation around the world, and then we're gonna look at a couple countries, regional plays, and then we're gonna look at some stocks and some indicators. So I just wanted to rehash. Last week, we published an interview with Andre Marchand that Alan and Mike participated in. So that, and then we wrote about August being a seasonally positive month for NASDAQ stocks and for small caps, which is kind of surprising because August is usually a down month or a negative month for most stocks, but during election years, it kind of turns around to be the actual best time for NASDAQ and small cap stocks. So that's worth a read. And then we'll be publishing the annuities talk that Veronica and I did. It's in Russian, but it'll be on YouTube and on our Russian version of the site. So you can go to the blog, and if you're interested in annuities and what annuities are available around the world and in Russia comparably, then you can look at that. So that was what we did this week. Mike, why don't you talk to us about what happened, the continuing inflation issues, interest rate issues, bonds, and I think currencies really deserve some attention this week, right, Mike?
What sparked my interest was sharp upwards movements in the euro and sharp upwards movements in the dollar, and clients were asking me, so does this mean everything is really improving and the economies in Europe and the UK are great? Starting with the slide that says going nowhere is a clue that US interest rates are not going to rise for 5 years. In the context of Fed intervention, what this has led to successfully is avoiding deflation, which was a fear here, and a slight tick up, well under target still, in inflation. So thinking of the gap now between this number and the last slide getting wider, what you get is this, which is real yields in US treasuries. So this is what the reality in the world is in US interest rates. This is the line that is accounting for other currencies looking good. So what's happening in the euro and sterling is not a great piece of news for the European markets. It just reflects the impact of US interest rates on those currencies. And what I wanted to flag whilst talking about currencies is, because we're going to talk a bit about emerging markets in a minute, but what does this mean for the ruble? Ruble's been floating around 72 post COVID bottom, also heavily impacted, of course, by oil stagnation and uncertainty. So, but the ruble would benefit likewise. So, in theory, from this move in US interest rates. So you'd expect a ruble that's been around 72 to today be at 67, and the ruble today is at 74, which is partly oil related, but it's 74 in the context where the central bank has gone from intervening and buying foreign currency to stop the ruble being overvalued to the central bank in Russia is now selling foreign currency reserves in order to sustain the ruble. And I was trying to work out very quickly where the ruble might be if it wasn't doing this, and I came up with about 78 to 80. And if you go back to these slides and look at the long-term position on the dollar interest rates as flat, wonder where the inflation line is going, this is actually going to potentially put upwards pressure on, beneficial pressure on other countries' currencies. But for the ruble, we're seeing a very different story.
I wanted to mention that this has brought a lot of attention to local currency debt. You see people moving out of US denominated and euro denominated debt into local currency debt because they figure, okay, this is going to be strengthening against negative real interest rates in the United States. So there's a bid now under local currency debt. The reason I'm hesitant to even bring this up is because you got to be really select. Or last week we saw Turkey's bond market kind of blow up 6 days ago. It looks like $7 billion were taken on that market. So you got to be specific about what you want to buy in terms of debt. It has to be in an economy that's growing. And I think that's where Alan can kind of talk about which economies he's seeing that might be offering some kind of interest for sovereign debt investors.
So actually, I wanted to focus more on East Asia and China. You know, everyone's aware of a coming trade war potentially or likely, and one of the kind of darlings of the "I don't want to invest in China" school is Vietnam. They just signed. They were in the news this week because they just signed a free trade agreement with the European Union, which obviously will help their exports because it's a very similar market in many ways to China. And the first slide that you can see in front is basically how they are benefiting from the US-China trade war. China is still growing. Vietnam is growing a little bit better, at least from a lower base, obviously. But if you look at the China change and Vietnam change, you can see there Vietnam is after the last year, they are starting to really grow their exports. Krista, do you have the Vietnam chart there?
Yeah.
I wanted to be a little bit negative on it, or just a warning, because it's become such a kind of darling of the, as I said, of investors. And remember, it's compared to China, it's a pretty small country. It's 120 million people. And we'll see here the labor force, the labor population and labor force. Obviously, every country is dwarfed by China. The other interesting thing is that the biggest single and 1/3 of Vietnam's key import origin. So this is where the partially constructed goods and other resources that are required for Vietnam's infrastructure and the manufacturing sector, most of it comes from China, or a lot of it comes from China. South Korea are big in there, but China is basically funding Vietnam. And it's a lot of it is they will import raw materials for making, apparel, as various other FMCG type products, consumer goods and durables and other things like that. So they've got to get away from that dependence on China and actually focus more on domestic demand, which they're not doing that. They're not being able to do it, at least so far. And that's obviously a restriction on how the Vietnamese economy and the stock market can grow, because almost all of their money, to be blunt, is actually going abroad. There's very little, it's growing, but it's definitely getting dwarfed by the exports. Who owns the exports? Samsung is huge in Vietnam. Nike is huge in Vietnam. And Chinese companies are also increasingly using Vietnam, as we've just seen in the previous slide. So the domestic market really has to grow to take some slack and to grow, and they're not doing that. We have to be a little bit careful. Vietnam will grow. It's a great place to invest long term, but just be careful. Vietnam stock market has been characterized by incredible peaks and troughs.
The chart here, you've seen this issue here where we've kind of made this double top, and and it's rolling over. It's now below its 200-day moving average again, and below its 50-day moving average. This is not a value right now. So it's a place. This made me look up China, and China, after we had this huge, politically motivated kind of based on they were going to open up trade with the U.S. for specific chips again, and immediately the Chinese market skyrocketed in the beginning of July. It's pulled back here to an interesting place, actually. If the U.S. is actually going to suffer sometime maybe in September or October, China seems to be pulling away in terms of the COVID problems, and it's opened up Macau, and it's got a lot of stuff going for it that's good. And this looks like a potential, if we can get a bounce here off the 200-day moving average, this looks like a good setup.
I agree.
That was just something arbitrary I looked at like right now, but that wasn't something I wanted to really go into. I know you had something else about silver.
Again, going back to Mike and his inflation, we've discussed this before, that gold is also doing very well. Gold miners, we've covered that. But I think we also discussed that silver is a kind of much better proxy as an inflation, a signal basically, than gold is. And I think silver, the chart speaks for itself. I mean, it's tearing away, and that's showing that inflation inflationary environment, inflation is on the horizon. Who knows?
Yeah, we actually highlighted this recently, that there was a lot of call options back here around
on Telegram, on the ABC.
On Telegram, yeah, and we highlighted that. And if you even followed, you were near this trade, you would have been, you made a good 20% on this. I don't know if this is topping here, if you're going to see another jump up. Gold hit a new all-time high last week. These are things that are, inflation-related trades, and the fact that as Mike pointed out, the U.S. dollar is falling against all other currencies. Mm-hmm. Futures on interest rates are falling. There is this fear of inflation, and that's led to a buying spree in gold. And usually silver follows within a month or 2 month period after these gold run-ups, and that's what you see with silver here. We see a lot of people still bullish on gold, although there's always talk of there's going to be a pullback and an imminent collapse. I think something has to change in the economy before we actually see reasons fundamentally to change the position in gold or silver.
I think with the yield curve the shape it is, there's very little chance of a pullback on gold. You might get a short-lived correction, but a tiny thing. I think. Right. No, I was going to say one of the things I've been thinking about is actually what would be the mechanism for gold unwinding, because unlike so many other assets, gold is sitting on the balance sheet of central banks everywhere. If there was ever a reason, so let's say interest rates as a tool the central bank started to want to use, then you've got the potential for reduction in gold valuations. But gold, unlike most other assets, most other commodities, is sitting on the balance sheet and in the physical vaults of the central banks of the world. So a lot of the sort of life support that is going on appears to be attached to balance sheets that are attached to gold. So if you start to see gold prices unwind, then you're going to start to see impacts on basically countries' reserve levels in terms of valuation. So it's almost the gold price is too important now to fail with the economy in the condition it's in, is how it feels.
Mm-hmm. China will actually bid up gold prices if the US dollar continues to be under pressure. That has to change fundamentally for China to actually take a different stance on the value of the US. So did you want to comment at all on, Mike, on oil prices, or go into anything on oil? I mean, we always get a lot of questions from clients about oil.
I mean, we've seen the big European oil majors have just reported Q2 losses of unprecedented magnitude. Shell cut its dividend in Q1. It's Shell Midstream reported today. It met its forecast. It paid its guided dividend at 46 cents a unit. It's indicated that level will continue. That's a yield at 15%, and yet and its EPS was on forecast, and yet the price on SHLX has declined. I don't know how, probably 22% in the last 6 weeks.
Right. So these charts I bring up, these are actually, I think, are really critical, because they kind of underscore the issue we have with both the stock prices of certain large refineries like Shell, BP, Exxon. You see crude oil supplies not falling as fast as you would expect if the economy was to come back, fully. I mean, Europe's open, Russia's open again, but where's the growth? The U.S. supply of crude is still really high, and there's a lot of oversupply of this stuff in storage. And so
the elephant in the room is COVID wave 2.
Right.
Aside from the definition and questions like that, it's basically
that's where it shows up in these gasoline prices. You see gasoline days of supply, it fell drastically, and it rose drastically and then fell drastically, but that's kind of tapered off, and we're not back at levels that were pre-COVID, and that's kind of nerve-wracking. We can't bring these supply levels down, and that's just because there's a lack of demand, and that is a COVID-related item. And so that's going to put pressure going forward on Q3 earnings and full year earnings, major oil producers and refiners. And it's going to put pressure, I think, on oil-related currencies. So the British pound, the ruble, some Latin American currencies, so the Mexican peso. So let me bring up something I think is kind of related to that. And one of the things I read this week was from State Street Global Advisors, and it talks about clean energy versus traditional energy. We hit on this a little bit, but there's been a lot of investment in clean power indexes and stuff like this versus the S&P energy indexes. So you see a lot of people thinking, okay, now is the time to allocate to lithium, wind power, batteries, and stuff like this. People think this is speculative. Maybe it is speculative. I don't know, but that's where the money's going because they just don't see the interest or the alleviation of the problems with oil and around the oil refiners. That was one thing I saw. There was a couple other articles that I wanted to bring up too. One was from Goldman Sachs. This was dated June 22nd. Maybe it's already occurred because we saw some kind of run up in July in European equities, and now I'm a bit nervous about. We looked at Bud was one of the companies we looked. Budweiser. Today's selling off big after kind of a nice run in July. I'm a little bit worried going forward about these European end of summer kind of rallies, that were predicted kind of earlier this summer. Can they continue? So that's one of the things on my radar. The other thing on my radar, obviously, and we should have started actually with this. This is the big news event is, the Amazon, the Facebook, the Apple, and of course, Google come out with the earnings last night. They should have pushed, the NASDAQ higher. They make up 40% of the NASDAQ, those four companies, and yet the NASDAQ is down today, now down 0.3%. That just shows something is not right here, right? You got these tech companies up 5-6%. They make up 40% of the index, and yet the index itself is down. You see small caps, money flowing away from them today, down 2% in the Russell this morning. And here's a chart from Piper Sandler. This was in May. They saw this. They said, look, Amazon, Walmart, Prime Now. Walmart increased their revenues by $3.5 billion. 40% growth in Amazon's revenues. That's a company that's making $88 billion a quarter. Just wanted to bring up real quick the put call ratios. We've gotten to new lows on these, so there's no sales signal on the market yet. And it doesn't mean we're going to make new highs in the market anytime soon. That's what I'm seeing, guys. I just wanted to bring that up, but I think that's enough for tonight. So thanks a lot. We'll talk later then. Bye, guys.
Bye.
Great. Okay. Thanks, guys.